essentially a low-cost index portfolio to maybe strip it back into, some very basic information, or just buy the market. Right. So a low-cost index in, let's say, Australian shares will buy, say, the top 200 companies in Australia indiscriminately. It's cheap, easy to run, and you don't need to do.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are back again, back on the audio waves, and I just realised that we swapped seats.
We swapped seats last week.
We swapped seats last week. That's what it was. I was going to say this looks a little bit different to how we normally do it. So I was getting a bit of deja vu there.
Yeah, that's it. So for those people that are watching on YouTube, that obviously makes some sense. But that's
everyone else. That was a whole bunch of
exactly right. Look, let's get into it because apparently it's the first couple of seconds we need to grab people's attention, Andrew, and no, absolutely right. Actually, you know what? The title of this will catch people's attention. So what we're talking about to everybody today is this is a real life example of a client that we've got. No names, obviously. $2 million portfolio. So we wanted to unpack that, talk about how it should be structured, some of the things to look out for, and just how we would think about really going about that.
Yeah.
Andrew, where do we start with this?
Yeah, so we start at the end, Bills. That's what we do. We start with the end in mind. So a lot of people, when you are starting to talk about investments, the starting point is, what should I invest in? When in reality, the starting point is, what am I doing this for? What you're doing this for will help shape and determine the decisions that you make, not only on the investments, but the structure. So what's your time horizon? Are you, and we're talking about a $2 million portfolio here. So there may be some very lucky 18-year-olds, but I'm not going to say that that's the case. I'm going to say, are you a 40-year-old that still has a, working career ahead of them, have amassed a significant sum of wealth? And are you, utilizing this to give you options for the future? Is this a portfolio that you're drawing down upon now in retirement phase? Is this something that you've got a 5-year investment time horizon? What are you trying to achieve off the back end of it to start to formulate the decisions on how you structure it and how that should be built now?
Yeah, and I think even though we are talking about a really hefty sized portfolio here, I mean, everything that you've just mentioned there applies whether you're just starting out or whether you've got an existing portfolio as well. So fundamentally, those foundation questions that we do ask are the same regardless of the size of the portfolio. And it absolutely makes sense. And not only just investing, but with most things that you do in life, when you are planning something and trying to achieve a particular goal or a target, start with the end in mind and then work your way backwards, understand your why, and then start figuring out the steps associated along the way with that as well too. So we think about risk tolerance. Yeah. How much risk are you prepared to take? Or not necessarily are you prepared to take, but you need to take in order to achieve your goal, which then rolls into your time horizon. How long is your time horizon for this? Is this something that's just there and I'm building wealth just because I'm building wealth? Or is it because I'm doing it for a specific reason like you outlined before? And then the income required out of the back of that portfolio. Is there income? Is it just going to be a capital drawdown? What does that then look like? All of that ties in nicely to what we deem as an investment strategy.
Yeah.
And you've got an investment strategy, which is, as it suggests, basically it's a written plan about how you treat and how you act with your investment and sort of setting some rules up for yourself in terms of what you do at particular points in time, because it helps you kind of stay focused on that North Star target. And when all of the noise happens around us, like what we're experiencing today in the world, you can stay focused on why you're doing it, what you need to do, and just use that as your North Star.
Yeah, exactly. And if you don't know these things, it makes all of the decisions that you make today, it skews a lot of the decisions that you make today. So what I mean by that is, like, if you don't have an investment time frame and you don't know what you're investing in, you've just amassed an amount of wealth and you've just put money towards investments because it sounded good and it sounded right. Well, all of a sudden, oil prices shoot through the roof, investment markets start declining, there's concerns around, increasing interest rates, inflation, and your decision is, oh crap, it's not looking good. I need to sell down. Versus the person who actually has an investment strategy that says, hey, I'm in here for the next 10 years. Okay, well, all of this noise may be happening now, but what's the likelihood that this is going to impact my portfolio in 10 years' time? Or what's the likelihood the markets are going to be lower in 10 years' time? Probably close to zero. So great, I can continue forward and make decisions that are still going to be, to maximize the investment, but not necessarily concerned about all of the noise and everything that's happening here and now. So it impacts not just, how you're structuring things, but all of the decisions that you make along the way.
Yeah, and I'm just smiling here because if you think about just the last little bit in terms of history, you think about what we've experienced, and there's a lot of things that are happening in the world where you'd look at stuff and you'd go, oh, it's the wrong time, or I need to pivot, or I'm worried about this, or I'm worried about that. And that seems to be occurring more and more frequently these days.
Yeah.
So you definitely need that to, like I said, keep that as your North Star. Andrew, pivoting into the actual investment style itself.
Yeah.
So with this particular client, we're going to talk about a core satellite approach that we've got. We'll unpack that, the reasons why. Core satellite investment strategy. What does that look like?
So there is and has been a lot of debate that will happen once you start, looking at underlying investments. And most of the time people will sit on either one side of the fence and they'll say, hey, you should invest in a low-cost index portfolio, when other people will say, hey, you can have some exposure on active investments and overperform the market. Now, what you're trying to achieve and whether you're, beating the market, that's a different conversation in itself. But essentially a low-cost index portfolio, to maybe strip it back into, some very basic information, or just buy the market.
Mm-hmm.
Right. So a low-cost index in, let's say, Australian shares will buy, say, the top 200 companies in Australia indiscriminately. It's cheap, easy to run, and you don't need to do a lot of think work about it. A active portfolio will look to try and identify businesses and companies that are undervalued in order to achieve a higher rate of return and in order to generate growth. Now, some people believe that keeping costs down and doing an index portfolio is the best way to manage things. Other people believe, no, an active portfolio can give you some overperformance. What a core satellite is that you're doing a combination of both. And in this particular scenario, that's what we're doing for this client, whereby you're having elements of both an active and an index part of the portfolio. And it's not about trying to beat the market, so to speak. There's obviously some intentionality to achieve returns above beyond market rates of returns. But what you're trying to do is have a core part of the portfolio that's getting your low cost, index market rates of return. And then you're taking another portion of the portfolio with what you're trying to achieve is a higher skewing towards franking credits, for argument's sake, and dividend yielding stocks, because it can be in a low tax environment. And so all of a sudden you're not trying to just overachieve is what you're trying to do. You're having a part of the portfolio that's going to move in line with market expectations and another part of the portfolio that's designed to do something different. And in this scenario, it's franking credits and dividends, give a little bit more certainty and tax benefits into the portfolio to enhance the portfolio, so to speak.
Yeah. So I guess when we dig a little bit deeper with this as well too. So what you're referring to is the portfolio construction methodology. And if you look at that and go, okay, put yourself in the shoes of that person who's got a $2 million portfolio, there's a balance between capital preservation and obviously growth. So looking at this and going, okay, what level of risk and fees do we want to incur in order to preserve and grow that portfolio that we've got, as opposed to, maybe if you're a younger client or if you're a younger person, your balance isn't as big. You're like, okay, I need to grow it. So I have to go more aggressive, coming back to the asset allocation, the risk that I want to take from my comments earlier. So you go, okay, maybe I need to go more aggressive, and the capital, the risk of losing my capital is less of a consideration because I've got less money and I've got a longer time frame. But in this particular instance, that investment methodology made sense because we're trying to get the balance right between those two things. So happy to get the market rate of return for the majority of the portfolio, low cost, just keep chugging along and we will get what we get. Then having the other satellite part of the portfolio, the other 20%, actively trying to outperform the market and find investment opportunities that are undervalued and are going to perform over time. So I think that helps sort of put it into a little bit of context that it's for that particular portfolio, that makes sense. Everybody's situation is different, so we might take a different approach for somebody else in a different scenario. But if you've got a couple of $1 million, there's obviously there's a lot more thought because we always think about it equally, but there's a lot more consideration in the eyes of the client around needing to protect that capital as well too. So it's a really intelligent way of constructing a portfolio and kind of getting the best of both worlds.
Asset allocation, not asset allocation, investment structures, Bills. I think this is a thing that we're probably most passionate about as advisors, but I guess the structure of your investments can have significantly different outcomes, even if you're investing in quite literally the exact same thing.
Yeah, and this is not necessarily portfolio construction that we were talking about before in terms of what type of assets do you purchase, what's the strategy, what's the style. This is more about the entity itself, and we'll give an example. And we always talk about, say, superannuation versus non-superannuation. And when you think about, I guess, from a performance perspective, all else being equal, there's obviously two things in relation to super that I guess turbocharge the performance of an investment. Firstly, it's the tax opportunity because superannuation is concessionally taxed, and from that perspective, that is the lowest tax environment that we have available in Australia, and I think will be for quite some time. The next part is the rules of preservation around superannuation. Yeah. What does that mean? Basically, once you put money in, you can't touch it until you've met a condition of release. So you can't touch it till you call it retirement age, right? So those two things combined, if you're comparing that environment versus, say, owning the exact same assets in your personal name, the difference is very, very substantial. One, because of, you're forced with the time frame, but let's say the time frames are equal. From a taxation perspective, the taxation point of view is going to make a huge difference when you're getting taxed at 15% if you're in accumulation phase versus your marginal tax rate if it's in your own personal name. Massive difference.
Yeah. And so you're considering, when we're starting to build this out, you're considering, okay, well, what's your investment horizon? What are you trying to achieve? And superannuation is a great asset, but if you're 40 and you want to start drawing down on this $2 million portfolio today, it's basically irrelevant to you because you can't access it until you're 20 years time, at the earliest, so to speak. And so you're doing a combination of a few things, because if you have a $2 million portfolio in retirement phase, that's where you want the money to be sitting 99% of the time. But you have caps as to how much you can put into the portfolio at that point in time. You've got capital gains implications of selling outside and moving inside. And so this is something that you need to do over time rather than a silver board that you can do all at once. So, okay, superannuation will form part of the portfolio with assets that may not necessarily be required as at today. But then it's, okay, well, the remainder of the assets that I need liquidity and access to now, do you hold it in your personal name? Do you hold it in a spouse's name that's maybe at a lower taxable income? Is there, an option to hold that in a trust? Do you then look at bucket companies and distributing assets to bucket companies through a trust? Do you look at, company investments? All of these things, you're going to factor in a client's circumstances, when they're likely to need the money, the structure of the investments, the asset protection. So, if you are self-employed, there's some differences, on how you may structure it. You're looking at the tax implications of it, when you actually need the money, and you're bundling all of that together to help formulate a plan of, okay, this is how much you allocate. Because it's not I'm going to put everything in one bucket. It's how much is in this bucket, how much is in this bucket, and how much is in this bucket. What are the costs of managing it all?
Yeah.
Because you can look at the best tax strategy and have trusts and bucket companies and self-managed super funds and all of this. And if you're going to be paying, financial advisors and accountants tens of thousands of dollars a year to manage all of it and do your tax returns and, make sure that it's compliant, it's irrelevant if that's going to outstrip the benefit. So what's the cost benefit of everything that we're doing to make sure that it ends up in your favor to be the most opportune outcome?
Yep. Andrew, pivot into the portfolio in particular that we're talking about, and this person. So this portfolio is not inside superannuation.
Yeah.
So one of the things that was really important to the client in this regard is the lifestyle that it does support. So we're talking now about the income associated with it. So getting the income yield right in terms of where does that need to sit to support the lifestyle versus the capital growth aspirations and the appreciation of the actual asset itself. Going a little bit deeper and going, okay, the way that the portfolio is structured, can we get enough income or enough yield off it in order to support the income requirements or the lifestyle needs without actually having to sell down any assets as well too? So there's a little bit of thinking in terms of what that looks like, specifically in the active part of the satellite part of the portfolio. And then Andrew, going back to what you were talking about with dividends and distributions and particular drawdowns.
Yeah, I mean, it's all about where are you going to be drawing the income from? Because you can have a portfolio that performs at 10%, but if you're incurring a capital gain every single time you need to draw money out of the portfolio, it may not be as beneficial as necessarily having a income that's drawn down from investments where there's franking credits associated with those dividends. So again, you're looking at designing the income and how you want that to flow to the person that's actually living off that income, rather than just chasing an end return number. And as you're starting to factor all of that in, and in this scenario, we're then considering debt as a tool. So there's some owner-occupied mortgage that's associated with it. And in this scenario, what we're talking about, or what is a part of this strategy, is a debt recycling strategy, whereby you're utilizing debt recycling to help facilitate pay down an owner-occupied debt and increase your investment debt. So that debt is a tool that you're utilizing in order to be able to maximize the tax position at the end of it, rather than just something that you're adding risk into the portfolio by throwing debt into it. So utilizing those concepts of, okay, well, what are we trying to do? What are we trying to achieve? Helps inform, okay, well, how are we going to put it all together? And, are we going to utilize debt in this scenario, or is this not something that, meets our risk tolerance, or is there just no need for it?
Yep. I guess a further extension of that too, when you are talking about using the income and taking that out of the portfolio as well too, coming back to that tax question. So the tax drag, silent killer, we all have to pay tax, unfortunately. The government's trying to get more and more out of us, and we're trying to pay less and more. We're trying to pay less and less. But you think about what that looks like. Capital gains tax if you're discharging a portion of the asset versus income tax if you are taking money out to live off. The timing of what that looks like. How does that coincide with your level of income that you're receiving? Like what you were saying, maybe you've got a spouse or a family member. If it is through a trust that you can distribute income on the lower tax bracket, what does that look like, and the timing associated with that? Superannuation, we did touch on it before, completely different story. You're talking, once you're accessing superannuation, you're not going to be paying any tax, subject to your balance, of course. But tax plays a really big part of it, which goes back to, I guess, the earlier comments around the structure and where investments are held.
Yeah.
If you're talking superannuation, you can pretty much take tax off the table as it currently stands. Who knows what the government's going to do down the track, but as it currently stands, once you're in pension phase and you start drawing down, you're not paying any income tax on that unless you've got really big balances and stuff. But that's not the case in this situation.
And and it's not actually for this client's situation, but another example, and it's fresh in my mind because it was quite literally half an hour before we recorded this podcast. Utilizing all of the tools that are available to you. So was talking to a client. They've had some changes in their circumstances whereby one of them is self-employed. There's obviously variability in their income. The other person was running a business, and that business is no longer in operation. So the business has closed down, and he's now doing a contracting role. But what's happened in that scenario was that cash flow has been fairly disturbed in the last 12 months. And where we'd ordinarily want to get superannuation to be, at the cap of $30,000 a year for them, they're not going to meet, or they're not going to be able to meet that through the cash flow because their income has basically been as expected. So what we're doing in this scenario is saying, okay, well, we've got 2 superannuation funds and we've also got an investment account. We're going to have access to the super within the next 5 years. So liquidity isn't necessarily a concern, but we still want to reduce our tax position as much as we can. We may not necessarily have the cash flow to do it, but hey, we're going to transfer a portion of assets from our investment account into each of our superannuation funds to bring us up to that $30,000 limit. So the ongoing management of not just the investments, but also the strategy, because you can lay or set out the best laid plans at the beginning and say, okay, well, we've got the cash flow to do this, and this, and this is where we're going to get to. And something changes in your circumstances and there's a speed bump in the road. And all of a sudden the question is now, okay, what do we now do? And while we can't go to the most opportune scenario, what's, the second best option, as opposed to just saying, oh, we're going to for all of the tax benefits this year because we don't have the cash flow to do it. So really making sure that whatever you're setting now is obviously right for now and your circumstances now, but in the future, obviously the investments will change, but also the strategy will change, the strategy will pivot, the strategy will adjust in order to take advantage of, your circumstances and what's going to be best for you in that situation.
Yeah, and that's the thing. I mean, look, the one constant that we see all the time is that things change, right? And you need to be in a position, I think, to be able to capitalize off that, maybe anticipate it, maybe reposition yourself. It's never set and forget when you're looking at investments.
The analogy that I like to use is it's like you're sailing a boat from one location to another. Now, at the very beginning, you're going to point yourself in the direction of exactly where you're going to head to. And that's fine and that's correct. But setting it and then saying, okay, I'm no longer going to look at it. I'm going to leave my hands off the wheel and I'm going to go, have lunch at the back is not going to be the strategy that's going to get you there, because a slight deviation at the very beginning means a huge deviation to where you're going to get to at the end. And so you're constantly realigning and you're constantly pivoting back to heading towards that North Star.
Yeah, no, good analogy, Andrew. Hopefully we did that one justice. But yeah, $2 million portfolio, some of the things to think about, but not only is that relevant for a $2 million portfolio, I think there's a lot in there as well too that applies to absolutely
$50,000.
Yeah, for absolutely everybody as well. But Andrew, thank you for today.
Thanks, Bills. Appreciate jumping on the podcast as always. And thanks to our viewers and our listeners. Thanks for tuning in. If you did get some value out of that one, we'd love if you could like and subscribe, and we'd look forward to catching you on the next podcast.
Thanks.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amiridis and Andrew Nicolaou of 360 Financial Strategists Pty Ltd, authorized representatives and credit representatives of Akumin Financial Planning Pty Ltd.